So big danger is investments can fall in value. The stock market bounces around, and that's scary regardless of how old you are. If you're 20 and you see a portfolio drop, it can be horrible. But it's a particular risk if you're in retirement and you're drawing on your pension and effectively selling your investments because you need the money to live on.
Hello and welcome back, everybody, to the Personal Investor Podcast. I'm Ed Monk and I'm joined today by Fidelity's Jemma Slingo to talk about how best to use cash savings in your financial mix in retirement. Having a big chunk of ready cash on hand is always nice, but can it make it harder to hit your retirement goals? What's the right amount of cash to hold? Before we get into the details, please let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Jemma, welcome along. Why don't we start with why this question of how much cash to hold changes somewhat when you move from being a person in work and earning a salary to being a person in retirement?
Yeah, so if you're working, you obviously get paid. And for lots of people, you get a regular salary every month. So it makes it pretty straightforward. You know what's going to be coming in, you know what you're spending, and your financial situation is relatively stable. But when you retire, obviously, you're not getting paid anymore. You're having to generate your own income from the pot that you've accumulated over your life. And you're having to think how to generate that income. What's the right mix between investments and cash? You're also thinking about how big a cash buffer you might need if your income strategy goes awry, or, things in your life change and actually you need more cash than you anticipated.
Yeah.
So that's all going on. And then to make things even more complicated, you don't really know exactly what your time horizon is, because
That's right.
No one knows how long they're going to live for, really. So you're making a bit of a guess about how long you need your money to last.
Yes, and we're going to run through today all sorts of different sort of ways into that question. I guess we're talking mainly about people who are living from an invested pot of money in retirement. We'll address some other situations as well. But first of all, I guess one thing that doesn't change when you move into retirement is that you still need some money in cash for genuine emergencies, right? And it might be different from when you were working, but that sort of in concept, you still need that chunk of money as well, don't you?
Yeah, so the general rule of thumb is holding 3 to 6 months worth of essential outgoings in like an easy access account. So if you lose your job, if your boiler breaks, if suddenly there's some sort of emergency, you've got cash on hand to help you sort of weather that storm.
Yeah.
And that's the same for whoever.
Yeah, and quite a personal question about how much that should be. I think it just depends on how comfortable you are. We're here to talk about retirement, but if you're a working person, one of the emergencies, as you say, might be loss of income. Well, how long do you want savings covered or your income covered for, basically, before your money runs out? And that's going to be up to you, isn't it, really?
Yeah, and it's a thread that runs throughout the whole thing, really. A lot depends on your temperament, because
Indeed.
If you're a very risk-averse person stressing about what's going to happen to your money, you'll probably want more cash than someone who's a bit more cheery about the state of the economy or the state of the markets, and who's happy to weather a bit of volatility.
Okay, so beyond that money then, what about the money that you need to sort of hold alongside investments? What are the dangers of holding too much cash? Because really, a lot of people might come to this question and say, well, you can't have too much cash. But from the point of view of investing your money in retirement, what's the danger of too much cash?
So it all comes down to growth. So the last 3 years, cash has actually got a lot more attractive because we've had higher interest rates. But over longer periods of time, it's massively underperformed other assets, particularly equities. So, if you'd invested in the stock market, you would have grown your pot by far more than if you'd just kept safe in cash.
Yeah, and I think actually numbers that you quoted writing about it in the last couple of weeks, looking at the past 5 years, had you put £10,000 into cash savings 5 years ago, you'd have something like £10,700, a little bit of interest. Compare that to what would have happened in the S&P 500, the American stock market, your money would have doubled. You'd have £20,000. So a huge difference in sort of potential performance. Obviously, the risk with investments is that they could go down as well. And you don't have that risk with cash. But the point you're making, I guess, is that you need that growth potential in retirement because that's what's going to ultimately pay for it in the long term.
Exactly. And I think you say the long term, it is the long term because I was looking at the ONS calculator they have for working out life expectancy. I think if you're a 65-year-old man today, odds on you'll live till you're 85. And women actually live a bit longer. So I think about 88.
Yes.
So you are thinking 20, 25 years ahead. It's not like your investment horizon suddenly shrinks to a tiny number once you retire. And obviously that's important when you're thinking about balancing your cash and your other types of investments.
And one of the other dangers about cash, the thing you always read about in connection with cash, is that it loses value versus inflation. Investments do that as well, actually, but investments have a better record, don't they, of beating inflation. Give us a sense of the risk that inflation poses to cash.
So one of the reasons people love cash is because they think it's really safe.
Yes.
And it doesn't lose face value. But as you say, you've got inflation secretly working behind the scenes, and that's eroding what you can actually buy with your cash.
Yes. We've actually got a chart I think we can bring up to show the record of cash versus inflation.
Yes. And you can see on the screen sort of what's happened to inflation, what's happened to interest rates over the past 20 years. And a lot of the time, inflation has been higher, if not significantly higher, than interest rates.
Yes.
Which means you're actually losing money in real terms on the cash you're holding.
Yeah.
And you can see on the right-hand side of the screen that big spike in the orange line. And that's when inflation shot up after COVID. And that was a particularly bad time to be a saver. Last 3 years has been a bit different. We've had a bit of a grace period because inflation has been lower than interest rates, and they're just closing in on each other now.
Yeah, I think as we're recording, they're almost the same. I think inflation's about 3.6%. Cash rates, you'll probably get higher than that. I mean, the line you can see on the chart is the Bank of England rate, which is a bit of a proxy. It's not exactly what you'll get. The best cash rates might be a little higher than that. A chart like that is interesting, I think, because it shows, as you say, the last 20 years, a lot of that will have been the period since the financial crisis when rates have been very, very low. If you look over much longer periods, cash actually does have a bit of a better record of beating inflation, but never by that much. I think that's the point about it. It never really beats it by much. And as we can see on a chart like that, you can have really painful periods when cash is eroded by inflation. On the flip side of all of that, there is the danger of not holding any cash at all. Taking the approach, I suppose, that, well, I want my investments to grow. I believe they'll grow. They've got a better record of growing faster than cash anyway. So let's just leave it there. What's the danger of that approach?
So big danger is investments can fall in value. The stock market bounces around, and that's scary regardless of how old you are. If you're 20 and you see a portfolio drop, it can be horrible. But it's a particular risk if you're in retirement and you're drawing on your pension and effectively selling your investments because you need the money to live on. And that's because of something called sequencing risk.
Yes. That's
a horrible bit of industry jargon, but it's basically the effect that timing can have when you're drawing on your pension. So if we take two scenarios, you've got Peter and Paul, they've both saved the same amount. They live for 30 years after retirement. They achieve the same average returns on their money. You think, okay, they're basically in the same boat.
Yes.
But if we think Peter was retiring during a bull run, so when markets were going up, and Paul retired just before markets crashed.
Yeah.
That actually has a huge impact on how much money they have in their retirement. So if you're Paul and suddenly the stock markets crash just after you've had your retirement due, that will really, really hinder the returns you can get over the 30-year period because you're having to sell your investments once they've lost value in order to, draw that income, sustain yourself. And it gives you fewer units at the end to recover from the eventual bounce back in the markets.
Yeah.
So it's that idea that what happens early on in your retirement is actually really important.
Yeah, I mean, and to sort of put that another way, I guess at the start of your retirement, when you're going to be withdrawing money for years to come from this pension pot, you've still got a big exposure to risk assets and the stock market and other investments at that point. So a big move in markets then really hurts you. and you have to then sell assets when they've fallen in value to get the income you need, as you say. So you can have exactly the same overall, annual return, but that sequence of how you get your returns matters. So bearing all that in mind, what are ways to combat that sequencing risk?
So one of the popular ways is to hold a big chunk of cash.
Yep.
So if we go back to the very start when we were thinking how much cash might you want to hold, experts suggest anywhere between 1 and 5 years of income. And obviously that's a really big scale because 5 years of worth of income in cash is a lot.
Yes.
But it should be enough for you to weather out any horrible market downturn, mean you don't have to touch your investments and you can just live off that cash that you've got tucked away somewhere.
Yeah. How that would look in practice, I guess, is that you have a chunk of money worth X years of income that basically will give you your income in the short term. Then you've got a bigger pot of investments, hopefully behind the scenes somewhere, sort of doing its thing and hopefully growing over longer periods. But taking your income in the first place from that cash reserve means that investments can fall up and down, and you don't necessarily have to feel that in the income that you're getting. You've already got that cash, and it gives you a longer time frame, doesn't it, for investments to recover?
Exactly. And crucially, you're not touching the equities.
Yeah.
You're not drawing money out of the stock market when they're down. You're just letting it do its thing, ride up and down, and hopefully eventually recover.
I mean, 5 years of income seems like an awful lot. And I think a lot of people would say, look, that's the opportunity cost is too big to have all that money not in the market when I need that sort of 7% average return or whatever. I need that from my investments to fund my retirement. And if a big chunk of my money in the first place is sat in something that's not going to do that, then basically 5 years might be too much, but 2 years might be more worth aiming for, because yes, you could have a pretty big wobble in markets but 2 years is quite a good amount of time history would suggest a market will recover within 2 years, right?
Yeah. And there is also another approach you could take, perhaps alongside having a big cash buffer, and that's by living off what's called the natural income. Mm-hmm. So let's say you've got some money in stocks, some in cash. Your cash is generating interest. Your stocks hopefully are paying some nice dividends. By living off the natural income, you're just taking those dividends and that interest and using that to live off, and leaving the underlying investments untouched. So again, it's that same idea that you're not sort of eating into your pot that can keep going up and down and growing over time, but you're just sort of creaming the income off the top. Yeah,
and a lot of people will invest specifically for that. So they'll look for dividend-paying companies. Bonds pay interest, similar thing. But even if you were just investing in sort of stock markets generally, there's normally an option to kind of turn on the tap of income by going for a particular share class of a fund, or as you say, reinvesting the dividends or not. So that's another kind of way to finesse the income, isn't it? And it means you don't have to sell assets when they're down in value. And that really is the watchword for all of this, right? If you can avoid having to sell assets after they've fallen in value, that will help you sustain your pot in the long run.
Mm-hmm. That's right.
Okay, I just wanted to spend some time on something that you wrote about, which is a little counterintuitive perhaps, which is something called an equity glide path. Tell us about that and how it sort of fits into this management of risk around retirement income.
Okay, so the equity glide path basically turns the traditional approach to retirement on its head. So normally you would approach retirement, still have quite a lot in the stock market. And as you get older and older, you gradually de-risk your portfolio away from stocks into stuff like bonds and cash, because as we've said, less likely to go up and down. As you get older, you'll have less time ahead of you to, wait for markets to rebound, basically. But in that situation, you've obviously got the sequencing risk issue. So the equity glide path basically reverses it and says you start with more safe assets, so bonds and cash, and actually re-risk your portfolio as you get older. So shift more into equities, because once you're older, that sequencing risk doesn't do as much damage. So it's an interesting idea. I hadn't heard of it until recently, but it does just make you think, actually, there's not necessarily this one set path you have to take once you retire.
Yeah, and listening to that, and I read it in your article as well, the sort of logical part of my brain says, well, you must take a hit on overall what you can expect the growth of your pot to be, because you don't have that money invested or as much of it invested for as long.
Mm-hmm.
But maybe it reduces the range of outcomes that you can expect, because, as you say, you don't have this big issue of big falls at the start of a kind of withdrawal process, which are really, really painful. So yeah, it's an interesting one. Just finally, let's have a word on if you have your income sort of organized in different ways, particularly if you have guaranteed sources of incomes from annuities, perhaps from defined benefit pensions as well.
So that's a lovely position to be in, basically. So
yeah, that's what you want.
If you've got a defined benefit pension, great, guaranteed income, you know what it's going to be. And similar with an annuity, you know exactly how much you'll be receiving. And that basically reduces the need to have this big cash buffer, because it's a bit like being employed, but better, really, because you're not going to lose. You don't have to go to work. You're not going to suddenly lose your job. You've got guaranteed income. So obviously you still want a bit set aside for those emergencies that we talked about.
Yes.
But that need to actively dip into your cash savings because the markets have gone crazy is basically gone.
Yeah. So no need for that sort of cash reservoir effect that we were speaking about before. Okay, well, Jemma, we've covered loads there, so let's leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. It really does help other people find what we're doing here. That said, Jemma, thanks for joining me.
Thank you.